I'm Olivia Voznenko.
I'm Steve Guilfoyle, and this is Street Smarts.
Where to begin? How about, hello, Stephen.
Olivia, I was going to get a guest today. I was this close, but the volatile markets put me in a position where I felt we needed to address our viewers. Our viewers, I feel, are mostly retail traders. I know we have some professionals in there, but I think the retail traders are the ones that get hurt the most during times like this, and I felt we really needed to address them as close to one-on-one as we could.
I mean, we're seeing things that even the pros haven't seen, right? It's all new, so let's get it rolling. True.
I think there's two areas that I think matter so much. That's investor sentiment and momentum. That's not being spoken of enough on TV, on the financial media. Investor sentiment and momentum are the two items that really have saved the market time and time again over the last 10 years. It's called buy the dip or buy the F dip. We've seen that a million times.
BTFD.
Well, since about January, late January, it's more sell the pop.
Sell the rip.
We're getting our rallies, but they're selling the rallies. So the whole ball game has changed. And I know for a fact that our younger traders out there have never seen this kind of volatility, but even us guys with the experience, even the older traders out there, we have never experienced heavy volatility in the algorithmic era, the high-speed era. So we're almost as inexperienced as our younger counterparts. This is a new game for everyone that's in the game.
Yeah, that makes a really good point, and it's because of the quants. It's quant-driven, the algos.
Well, yeah, I mean, I find that being an old floor broker, I'm partial to the auction market, to the open outcry market. And I still believe that was the fairest market model we ever had. But we're seeing with the high-speed trading and with the algorithmic trading that we're seeing drastic overshoots to both sides during the course of the same session, even within the same couple of minutes. You look one time, you look another time, it's drastically different.
It's ridiculous. Market. Like the futures, S&P, it's usually 7 handles, etc. And now it's like 20 handles, 30 handles. It's ridiculous.
60 handles. What's the difference?
60 handles.
Right? It really is. It's so I want our viewers to slow things down. I want to go through things piecemeal. Let them know what's against them, what's trying to hurt them,
okay,
and let them know where their friends are.
So you're talking, it sounds like headwinds and tailwinds.
You bet.
Later. Kobe.
Let's do headwinds.
Let's do it.
All right. What's in our face? Why is the market shaving forward-looking PE ratios? Because that's what they're doing. They're dragging the PE ratios in from the gaudy levels they were at to something that's more in line with historical norms, although history doesn't really matter anymore because humans aren't doing the trading. So it's a different environment, but they have done the job of dragging those PE ratios in.
Which, is that such a bad thing?
No, it's not a bad thing.
It sounds like they're around where they're supposed to be.
If this turns out to be a reset, and it might, then that's perfectly fine. Then it's actually been a healthy evolvement for the market to go through, although not the overshoots on both ends, but where we start and where we end up, it would have been a healthy move. We just don't know if this goes on for 9 months, if it goes on for a year, if volatility is the permanent condition now that we can't rely on quantitative easing. It may be a completely different ballgame, and we have to understand where the potholes are on this road we travel.
For sure. Okay, so let's go with the headwinds. Let's continue with that. So you're saying PEs are a headwind. Why is that?
Well, PEs are not a headwind. PEs are simply a measure. But the number one headwind right now is potential trade conflicts.
Let's talk about that.
All right, that's what's in the news. That's what everyone's talking about. That's China. That's NAFTA. And the issue there is that so many S&P 500 firms have revenue exposure to China, that if there is a trade war or tariffs that get out of hand, even just simple posturing that gets out of hand, these firms and their customers will likely suffer. And I'm talking big firms. I'm talking firms I own. Micron, for instance, a firm that I own, although I've cut back a little bit, a firm that I own and I have written positively of fairly recently, it has something like 51% exposure to China. Even the mighty Intel has, I think, 23.6%. So a lot of the tech names, which is part of this tech rotation, have
Is that
why
exposure. Intel was down? Because I thought it was because Apple was looking to make their own chips, and that's the reason why Intel got smacked.
Well, Intel has been hit with the rest of the tech rotation. That was a little icing on the cake. I mean, when it was down $4, maybe that was $1.
I mean, can they time this news at at a different time?
Well, Apple's trying to differentiate itself. from Facebook, but also stay in the news cycle in a positive
Oh,
way.
yeah, and quite a statement too, right,
So,
from Tim Cook?
Yeah,
You think that's going to come bite him?
I certainly understood why he did it, because he's trying to say, you, not me.
But what if it happens to him?
Well, that's what
Isn't it tech that's the issue right now?
Who collects more data on their users? We don't really know how much data they have on their users, but they probably have a ton of data.
Oh, yeah.
He's probably thinking that if they go after the internet stocks, well, what's to stop them from coming after me? I have a lot of information on my customers. I want to paint a picture where I'm not like them, and I think that's why he did that.
All right. Well, we'll see if that was the best move. IDK.
Yeah. No, I don't know. Another headwind facing us out there is the volatility in Washington. I think, as everyone knows, I'm not anti-Trump. I'm not anti-Republican at all. I'm neither a Republican or a Democrat. I root for our presidents no matter what. But I certainly think we could use some less volatility in the cabinet itself, and maybe a little less hostility on Twitter, especially when you're going after a corporation, a gigantic American corporation that isn't just a retail service anymore, but now it's really part of.
You're referring to Amazon.
Right, the internet economy. How many firms rely on Amazon Web Services?
I wasn't surprised hearing that he was going to come out with that statement. I was not surprised.
No, I'm not. But it did push the tech ETF rollover.
Again,
a little
timing.
further down the
Can
road.
he just?
So,
I mean, but he took credit for the stock market booming, and to make such a statement at this time.
Yeah,
if you take credit for something,
I didn't appreciate it. I thought it was bordering on inappropriate. I think I really wish that the president would lay off the Twitter account a little bit. As a trader, it doesn't help me in the morning when I say I take one look. I say, oh look, the futures are up 6. Then I take another look and they're down 25.
I know.
That doesn't really. I don't like that all that much, but it's a permanent condition. This man's going to be the president for anywhere from 6.5 to 1.5 to 6.5 more years, 2.5 years, whatever it is. And I doubt his personality is going to change very much, because he's had a lot of success with the economy in the early stages. He's had a lot of policy success. There's been no reason for him to reel back on the way he goes about things. It's probably a belligerent negotiatory style that's suited him well his entire career. So this is really what we have to work around.
And of course, these big moves that we're seeing, as you touched on before, they're algo-driven. Wouldn't that be funny? Quantitative easing and a different kind of measure. And speaking of that, let's go to LIBOR.
Oh, well,
just to touch on it, because it's really crossing headlines. Maybe some people don't follow it.
It definitely, a lot of loans, short-term loans anyway, are based on the 3-month LIBOR US dollar rate. And that rate has spiked pretty significantly over a year, but really more so over the last 3 to 4 weeks. It creates uncertainty for the equity markets. We're not seeing it across other LIBOR currency rates. We're not seeing it in other short-term markets. So yes, it could present a short-term liquidity squeeze. It probably will to some degree. And that might hurt the smaller firms that would benefit more from tax cuts. But I don't know if that's a reason for us to be selling equities just yet. I know some people have already taken that step.
It's not in dangerous territory yet.
It's not in dangerous territory, at least I don't think, unless you see it across, for short-term treasuries, for other short-term instruments. But it is going to, obviously, there are mortgages, there are short-term business loans that are based on these LIBOR rates. So obviously it's not going to be very comfortable for people and firms that need this kind of help when they're not all that strong to begin with.
It sounds like some sort of mythical creature when I talk about LIBOR. Well, you know, we'll get Peter Scheer on to talk about that, right?
Peter Scheer would be the best guy to get for this.
Peter
He's
Scheer,
obviously the pro.
We are calling you. Come. Come to Street Smarts.
I think he'll come.
All right, cool. We'll save that for another week. Okay, right. Stephen, let's continue.
Okay, we got the U.S. consumer. Now, for the U.S. economy to take off, the consumer has to take off. Wage growth, which we'll get to later, hasn't really been there for the average American just yet. Savings rates are dwindling. That could become an issue.
They've been low from the start, right?
Well, they've been going lower.
We're not the best. We're not the best at saving.
In the wake of the recession, that condition did improve for some time, and it's getting worse again. The thing that bothers me here, personal consumption is trouncing disposable personal income month after month after month. Right before we went, I only went back 8 months, and all 8 months it was decisively in the favor of consumption, which is being supported by credit card usage. Maybe not so much for January, but for the several months prior. revolving credit gapped up wildly.
Okay, question. When I first started interviewing you, we were talking about revolving credit being awful. So what is?
Well, the Fed has always believed that it was a positive, that it's a vote. It's the public's vote of confidence in the economy, that they're willing to go out and borrow in order to spend. I see it a little more cautiously. I see it that the average American may be trying to keep their children in a certain standard of living. And maybe they're finding themselves in a tough spot to get that done without taking out some kind of loan at credit card rates, which we all know aren't very friendly.
Right.
So I see this as a cautionary sign. I'm not crazy about that one bit.
All right, so now that we're co-hosting, we see it in a different light. Cool. All right. Anything else, Stephen?
Monetary policy. That's the biggest, scariest thing out there.
That guy.
Now, we just went through potential trade conflicts, the volatility surrounding the president, the rising LIBOR rates, and the U.S. consumer. But the biggest, scariest thing out there is monetary policy. All right. We have a rising rate environment. Right now, only a 28% chance of a fourth rate hike in December. But we all know, the way the ball is rolling, that there's going to be more of a push towards that in the second half of the year. Quantitative tightening is key. It's just gone up to $30 billion a month here in April. It's going to go to $40 billion in July. It's draining liquidity from the U.S. economy. It's supposedly in the background, but while we're raising rates. So monetary policy has the potential. It's not really getting tighter yet, but it has the potential to get a good deal tighter.
Absolutely. Those are two major forces.
Right, and the ECB is going to be cutting back on their quantitative easing at the same time. So we're not going to have that help from abroad that we were getting the last couple of years while the Fed was the first one on board with trying to get out of the easy policy of the last several years.
Exactly. It's not going to be so easy anymore.
This, in my opinion, is where the potential for calamity lies.
Wow. That's some heavy stuff, Stephen. All right, so do you have any good news for us?
We have friends.
Yay! Who are our friends?
All right, we have a rising...
The peanut gallery.
Well,
okay.
Atlanta Fed expectations for the GDP just rose to 2.8% from 1.8%. That's for the first quarter. Now that's key because 2.8%, even 1.8%, but 2.8% is outstanding for the first quarter for the United States of America. We have been through horrendous first quarters the last few years. So that's actually a positive. And if trends hold, that means we could do 3.5% to 4% later in the year. Maybe not for the whole year, but on an annualized rate per quarter.
Sounds great for business. That's
good for business. That's good for the economy. That'll be good for wage growth too. But it will also force the Fed to stay on track, even if they feel like they're walking into a policy error. So there's never a pure victory anywhere.
No,
right? So
okay, but we're still talking positives here,
right.
So let's keep going.
Stay with positives. We got WTI crude stabilized here in the 60s. Now firms can guess on their costs. They can have their best opinion. They can hedge their future prices, let's say for the airlines or so, going forward. There's more demand, rising demand for oil, which is good for the railroads.
And is that
pipelines.
because it's stabilized or because the number that's stabilized, the price that it's stabilized in, Stephen?
In some regards, yeah, the higher price here, it's better than 28 or 30 for crude. That's actually good for the economy in general. But the fact that it's stabilized is very good for business planning. I mean, this is not a bad price. And we've seen the Permian hasn't gone out of control. The shale drillers are still right around 800 wells drilling each week. It has not gapped up wildly, even though we're here between $62 and $64 a barrel almost week after week. So generally, I think that is a positive.
Okay, so shall we continue to talk about WTI or move on to... It's time for...
Market Rush. We should move on to Obi-Wan Kenobi.
Okay.
Because he's our only hope.
Okay, he's our only hope.
And that's what earnings are. Earnings, although we like the economy the way it's moving to some degree, and although WTI crude has helped, earnings have gotten us here, and earnings will take us where we go.
Yeah, and we're expecting more double digits,
That's
right?
We've had tax cuts and we've had deregulation, and this is the first quarter where they're both going to hit. We're going to see something out of both of those. We've seen some regulation improvements over the first year of Donald Trump's presidency. Now the tax cuts are going to matter. And probably looking for earnings per share increase for the S&P 500 of something like 15.9%, and revenue improvement of 7.3%. It'll be the sixth or seventh consecutive quarter of double-digit earnings per share growth.
Sounds gorgeous. I mean, PEs are coming down, right?
PEs are now in a cheaper spot.
At a cheaper spot. Now we have beautiful earnings. It sounds
we
like we're
should
building
have
a
beautiful
nice...
earnings. Now, the banks are up first. Energy is supposed to lead the quarter again. But the financials bat lead off, right? That's when you'll hear from JP Morgan. That's when you hear from Citigroup. And I think that's so key this time because we're coming into these earnings, coming out of a period of extreme volatility. We know the 210 spread on the treasuries hasn't done a lot. So we know that traditional banking isn't extremely profitable right now. We're going to have to count on the traders.
Okay, so Stephen, are you holding on to some hits that you took? Did you sell? Are you waiting to get through earnings?
I did get rid of Bank of America. That's been out of my portfolio now for a couple of weeks. I felt I was too heavy in the financial space. In fact, I felt I was too heavy in a lot of areas. But the financial space, I didn't trust traditional banking at that point, and I got rid of Bank of America because they're more reliant, I felt, on interest rates than the others. I hung on to Goldman Sachs, although I took a little off, because Goldman Sachs, if anyone's going to benefit from the volatility, trading-wise, it's going to be Goldman. If they flunk this test, they're all going to flunk it.
Yeah.
And I held on to Citi.
They've been good with that before.
True. I like Citi on valuation, and I like Citi on the way they have pledged to support the shareholder going forward. They're going to be returning a lot of funds to shareholders for the coming year, so I wasn't going to sell any of that.
No, and I'm sure you upped your cash rate, right?
I've gone higher in cash.
Yeah. I am all cash right now.
I've been higher in cash since January. I kind of got the inkling that we were overvalued about 5 days before we hit our peak in January. So I missed the extreme highs, but I went to a cash level above 30% in January. And I've never gone below 30% since. I've taken a hit on the rest of my portfolio, don't get me wrong. That's just like everybody else. But during this tech wreck, I have actually upped my cash percentage to 36.7%, which is where it is now, depending on the fluctuations of the last 20 minutes or so.
Yeah, exactly. Let's see where we are right now for some live action.
I think we're having a little rally here.
We're up 16 in the S&P.
All right, so it's coming in.
NASDAQ 21 and the Dow in triple digits.
Right. So we have some friends and we have some enemies. And I think that our home gaming friends have to really slow it down. If anything seems like it's putting you having trouble with it, or you're feeling like it's impacting the rest of your life, when you're messing around with your kids, it's on your mind. When you're trying to talk to your wife at dinner or your husband, it's on your mind. Well, then you have too much exposure to risk. Then you cross past the point of tolerance. That's when you have to cut back. Even if the stock goes higher later, don't have to sell all of it. I've cut back on a lot of my tech names, but I haven't gotten out of any of them because I like tech. I believe in the tech story. I believed in the tech story from the beginning. The demand's not going to go away. There's still a demand for autonomous vehicles. It's just been slowed down. There's still a big demand for artificial intelligence. There's cloud computing. These things are not going to go anywhere. What I have done is I've invested in Vietnam Fund, VNM.
Yeah, that's interesting.
Well, I see this is a little bit of a backdoor hedge versus my holdings that are exposed to China, because the U.S. Navy has started making ports of call in Vietnam again for the first time since the war. Vietnam is not a friend of China's. They are part of the original TPP agreement if that ever gets going again. They could be both a military ally and a trading partner. And if a lot of these firms need to move manufacturing centers or reroute supply lines, they may have to go through what's considered a frontier market because it will be a lot cheaper. It's not even an emerging market. Vietnam is a frontier market. Mm-hmm. So it might be a lot cheaper for them to do so in a country like that, where they're guaranteed the protection of the U.S. Navy. So
were you waiting on that move, or?
I was waiting on it for a little while.
You were,
yeah,
okay.
Yeah,
I had to ask you that.
No, that didn't come out of the clear blue. I was working on it for a bit, and I tried to get the pricing right. I missed the price I wanted by about 18 cents, but I got in.
Nice, Skillfoil.
Yeah.
All right, now, let's not finish on that because we have Friday, and we have the big boy talking on Friday, and we have non-farm payrolls.
Yeah, Friday's jobs day. You know, and it does matter because we're following the Fed very closely, right?
For sure. And the last month's jobs report definitely moved the market. I understand that
job creation blew out last month, 313. We're not looking for anything like that this time. Consensus is only around 175,000 new jobs on a seasonally adjusted basis.
So what's going to move the markets in this report?
All right, the market movers are wage growth, participation.
You taught me that. Mm-hmm.
Right? And average work week. Believe it or not, the media never pays attention to that one. If you get wage growth but a drop in average work week, it doesn't really count.
What is wrong with the media? What is wrong with us?
I mean, they're both measures of demand for labor.
All right, cool.
So we're looking for 2.7 on wage growth, 2.7% year over year. Last month was 2.6, down from 2.8. So we want to see some kind of rebound here
Okay.
to know we're back on track. Participation was very strong last month, 63%. So we can accept a little
That's
bit of
nice.
backtracking there, but we don't want to go too far. The consensus is 62.8. I would like to see us come in a little higher than that. I really would.
Okay.
And
But if we don't, that's okay as long as.
as long as we don't go below 62.8, I
Cool.
think we'll because that was a really encouraging pop to get to 63%. And if we can stay at 62.8% participation or better without having the unemployment rate get worse from 4.1%, right now we're looking for 4.0%, that would be fine. That would be considered a win.
Full shizzle. And then we have Jerome Powell.
We have Jerome Powell. He's the Fed head, and he will be speaking at 1:30 p.m. on Friday after
The
everything
chief.
else in the world is out from Chicago, and he will have the power to impact the marketplace. So you don't want to be goofing off somewhere on Friday afternoon.
All right, Stephen. Well, you know what? You seem pretty confident. So now I feel a little more confident.
I'm borderline confident. I'm willing to give confidence a chance.
Yeah. Thank you, Stephen.
Oh, you're welcome.
All right, cool. That was a really fun-filled, packed show. I think we have our viewers locked and loaded, definitely. So until next time,
Until next week.
we'll see you guys then.